Hey guys, back with another FAR1 video. So in this video, what we're going to do is that we're just going to quickly go through what is factoring versus secured borrowing, which is covered in Chapter 7 on pages 344 through 349. I just want to go over the basic conceptual difference and what they are, and then we'll walk through a quick example of each one. I just made these up so that way we can, they're somewhat basic, but they cover most of the points that are covered in the book as well. They're just different than the book. Okay, and I have sets of facts here that we can go through. So the first part, we'll start with factoring. Factoring is a complete sale of your accounts receivable. Okay, so what that means is that a company may have a ton of accounts receivable, but they need cash immediately. And so what they can do is that they can sell these accounts receivable to another company, and that company who's buying the accounts receivable will just give the company that needs the cash, they'll give it to them today. So that is, you're completely getting rid of the accounts receivable. You're going to actually credit off the accounts receivable, which we'll see in the journal entries. Okay, I have the actual journal entries written out, the debits and the credits, and we're going to fill them in with our example. Okay, so that's factoring, complete sale of accounts receivable. You don't own it anymore. Secured borrowing, on the other hand, is where you're going to pledge something or you're going to have collateral for a loan. Okay, so what happens there is, let's say you go to a bank, right? You go to a bank and you say, okay, we're XYZ company. XYZ company goes to a bank and they say, well, we need a loan, okay, of a certain amount of money, $100,000 or something. And the bank is going to say to XYZ, well, you know, how do we know you're going to pay us back? So what XYZ could do is they could say, well, we have these accounts receivable and we'll pledge them or we'll use them as collateral for the loan. So that way what that means is, let's say that XYZ fails to make payments on the loan. That means that the bank could just collect those accounts receivable and get paid. Okay, so XYZ still owns the accounts receivable versus in factoring they don't, right? They've sold the accounts receivable, they don't own it. Secured borrowing, XYZ or whatever the company is, they still own the accounts receivable. They're just using it as a way, as a means of getting financing, as a means of getting cash today in the form of like a notes payable or a loan, so that way they can finance their operations. All right, so that's the basic conceptual difference. I just wanted to go over that because I think that it's a little confusing as to what the difference is. Now let's jump into some quick problems. So again, these are kind of basic, but let's just go through it. The example, it's written a little bit small, but it's here in red. XYZ factors accounts receivable of $100,000 with its ABC company, and then ABC assesses a financing charge of 5%, and then the amount for probable adjustments like sales discounts, things of that nature, is 6% of accounts receivable. So it's 5% of accounts receivable finance charge, 6% of accounts receivable for the amount for probable adjustment. This amount for probable adjustment we're going to see in a second, but it just goes to this one here. It goes to the due from factor, right? That's always where that number is. You just say, if it tells you 6% of accounts receivable or whatever percent of accounts receivable, you multiply that by the amount of accounts receivable that you're factoring, and then you go forward. Okay, the way I like to fill these out, the first thing that I usually do is just put the accounts receivable in. So I write out the whole journal entry. I generally would know all the line items I need, and then the first thing I'm going to fill in is say, okay, I know for a fact that accounts receivable is going out. It's being credited off, right? I'm selling it. So that's easy. $100,000 would be right there, okay? Credit to accounts receivable. Next, we could do the financing charge or amount for probable adjustment. Either way, they're both pretty straightforward. Let's just do the financing charge first. So we would say 5% of the accounts receivable, which in this case is the $100,000, okay? So 5% of $100,000 would be, what, $5,000, right? So that means that that would be the amount that would go to the loss on sale of receivables. Okay, so loss on sale of receivables, $500,000. Quick note there, make sure you write out loss on sale of receivables. Make sure you're specifying what type of loss it is. Make sure you're writing out the full account titles to make sure you're getting credit. If you're just writing loss, you're most likely not going to get full credit. Just so you guys are aware. Then finally, due from factor, as we talked about before, that's the amount for probable adjustment. That's $6,000 because it would be 6% of $100,000, the accounts receivable. And then to find cash, it's just a plug, right? So 100,000 minus 11,000 between 6 and 5 would for due from and loss on sale of receivables. that would be 89,000 left as the cash plug. That's usually what I'll do, is I'll leave cash for the end. Okay, then, so that was without recourse. Sorry, I forgot to say that, but that was without recourse. That was example A. And then we have example B here, which is with recourse. The main difference here is that we have this recourse liability involved. And basically what the recourse liability is that, let's say that for whatever reason, one of the debtors to the company, so in this case it would be like one of the accounts receivable that's outstanding for XYZ, if they don't pay ABC after these accounts receivable are factored to ABC, then that means that XYZ is on the hook. They have to pay ABC a certain amount, and that's the amount is the fair value of the recourse liability. Okay, and so we record that as a liability because we might have to pay it out in the future. All right, so the way I solve these when they have the recourse liability, it's just going to tell you that generally. That's pretty much just always going to be given. So I just go ahead and plug that in there. I've already done that. We just plug it in there as a credit to recourse liability, right? If it's credit to a liability, increase it. Then I just do the problem normally. Okay, so I say accounts receivable, 100,000. Okay, the due from factor does not change based off of this recourse liability. That will stay exactly the same. So that will be 6,000. The cash also does not change. Okay, the thing that changes is this line item here, loss on sale of receivables. That increases by 10,000. Okay, we just basically say let's record additional loss, which makes sense because we're recording a liability. Okay, if we're recording a liability, we're most likely going to either record an expense or we're going to record some sort of a loss. That's how it works in accounting. Okay, so the difference, you can see the way to get from the first example to the second one is literally just to say everything is the same except for recourse liability. You have an extra line for 10,000, and then loss on sale of receivables gets bumped up by 10. Okay, so that's usually how I'll work those problems. Finally, secured borrowing, went over what it was. Again, not a sale of accounts receivable, very important. Let's go through a quick example. And this one is, it's relatively basic, but it's just illustrating kind of the main concept of what's going on. Okay, so first, just some quick facts. The company here, they have accounts receivable of 500,000, notes payable of 300,000. Okay, they want to get a loan of 300,000. That's what's going to end up happening. And so to do that, they're going to pledge these accounts receivable of 500,000. The financing charge is 1% of accounts receivable, so that'd be 1% of the 500,000. Be careful, right? Because there's multiple numbers here, and we have to make sure we're taking 1% of the amount that they're telling us. And in this case, they're telling us it's 1% of accounts receivable that are being pledged. Okay, so it's 1% of the 500,000, and then there's also a 10% interest charge on the notes payable. All right, so that's going to factor in later when we're paying out interest expense, and then we also have monthly payments. Okay, so that's going to be a journal entry later on. All right, so the first journal entry is right here. It's cash debited, interest expense debited, notes payable credited. Okay, so we know we're going to get a loan of 300,000, so that's easy to fill in first, right? We're taking a loan of 300,000. Okay, that's given in the facts. The next thing that we want to figure out is the interest expense. Sorry about that. And the interest expense, again, is 1% of accounts receivable like we talked about. So that's 1% of 500,000, which would be 5,000. Okay, and then the cash is just a plug. So it's 295. All right, so far we've said, okay, we're taking out a notes payable, get the cash, and record interest expense. The next journal entry here is literally just saying, this is just given, I just made this up. Let's just say we collected $200,000 of accounts receivable. There were no issues with bad debt. There were no issues with sales returns or anything like that. We just straight up collected that. That's pretty straightforward. And then the last journal entry here that we're going to do is we're going to say, let's say that we turn around and we say, okay, let's pay out the cash. This is crediting cash. Sorry if that's difficult to see, but this is crediting cash for $200,000. We're just going to take this cash we collected. We're going to straight up pay the bank back. Okay. The only complication here is this interest expense. The way we have to do that is that we have to say this is 10% on the notes payable. Okay, so we have to do 300,000 times 10% to get to 3,000. That'll give